What if I told you that most people who think they're financially safe actually aren't their savings? They have a job. Some even have investments. Yet when a real emergency hits, a sudden job loss, medical bill, family crisis, or economic shock, they collapse financially within weeks. Here's the mystery. Why do some people survive financial disasters calmly, while others spiral into debt overnight, even with similar incomes? It's not luck, it's not intelligence, and it's not how much money they make. It's something far simpler and far more misunderstood. The emergency fund. Everyone talks about it. Few people build it correctly. And almost nobody truly understands how much cash they really need to feel financially safe. Today, we're going to uncover the uncomfortable truth behind emergency savings, where the idea came from, why the famous 3 to 6 month rule exists, where it breaks down, and how modern economic pressure has changed the game entirely. But first, let's go back to where this concept was born. The idea of emergency savings didn't come from social media gurus. It didn't come from YouTube. It didn't even come from banks. It came from economic survival in the early 1900s. Most families lived paycheck to paycheck. There was no unemployment insurance, no credit cards, no easy loans. When income stopped, food stopped. During the Great Depression of the 1930s, millions of workers lost jobs overnight. Entire banks collapsed. Families who had no cash reserves were forced to sell furniture, homes, and personal belongings just to eat. Economists noticed something disturbing. 2 families could earn the same income, but only one survived financially. The difference? Cash reserves? Small savings cushions allowed families to survive months without income. That realization quietly reshaped financial advice for decades. By the 1970s and 80s, financial planners began formalizing a rule. Save enough cash to cover 3 to 6 months of living expenses. It sounded simple, logical, safe. But here's the twist nobody tells you. That rule was designed for a world that no longer exists. A world with stable jobs, lower healthcare costs, cheap housing, and slower inflation. Fast forward to today, rising rent, gig economy jobs, fragile job security, record household debt, and suddenly the old rule starts cracking under pressure. And this is where the real story begins. Originally, emergency funds were not about comfort. They were about survival. The goal was simple: prevent people from being forced into desperate decisions, high-interest loans, selling assets at losses, or falling into permanent debt cycles. Back then, people faced 3 primary financial threats. 1. Job loss. Factories closed, companies downsized. 2. Medical emergencies before modern insurance systems. 3. Economic crashes, sudden market collapses. The solution wasn't complicated investments. It was liquidity, cash you could access immediately. Not stocks, not property, not retirement accounts with penalties, just cash. That's why emergency funds were always kept separate from investments, because when emergencies happen, markets often crash at the same time. And here's something most people still misunderstand. An emergency fund is not about growing money. It's about buying time. Time to find a new job. Time to make rational decisions. Time to avoid panic-driven mistakes. But as economies evolved, the role of emergency savings became even more critical. By the 1990s and early 2000s, personal finance exploded into mainstream culture. Books, radio shows, financial TV programs. Suddenly everyone was being told, build an emergency fund before investing. Why? Because financial data showed a brutal pattern. People without emergency savings were far more likely to rely on credit cards during crises, turning temporary problems into long-term debt traps. One missed paycheck became late fees, interest charges, credit score damage, higher future borrowing costs. Emergency funds weren't just about safety anymore. They became the foundation of wealth building, because you cannot build wealth if you're constantly putting out financial fires. This is where the famous 3 to 6 month rule became gospel. The logic was simple. If the average job search takes 3 months, then saving 3 months of expenses protects you. If your job is unstable, save 6 months. Clean, simple, easy to teach. But then reality changed. Everything began to crack during major economic shocks. The 2008 financial crisis was the first major warning sign. Millions lost jobs at once. Housing markets collapsed. Job searches lasted far longer than expected. Suddenly, 3 months wasn't enough. Even 6 months wasn't enough for many families. Then came the COVID pandemic. Entire industries shut down overnight. Supply chains collapsed. Inflation exploded afterward. People who thought they were prepared realized something terrifying. Their emergency fund covered old expenses, not today's inflated costs. Rent had doubled, food costs surged, healthcare premiums rose. What once felt like safety now felt fragile. And here's the most dangerous illusion. Many people believe having some savings automatically means safety. But emergency preparedness isn't binary. It's a not have money or don't have money. It's about how long your financial oxygen lasts when income stops. And this is where most people get it wrong. Let's break down the psychology. When people calculate emergency funds, they often forget irregular expenses, ignore healthcare costs, underestimate job search time, assume quick recovery, overestimate job stability. They build savings based on optimism, not reality. But emergencies don't follow optimistic timelines. They stack, they overlap, they snowball. One problem triggers another. Car breakdown leads to missed work. Missed work leads to lost income. Lost income leads to debt. And suddenly the emergency fund disappears faster than expected. This is the hidden flaw in generic advice. Not all emergencies are equal. Not all incomes are stable. Not all living costs are predictable. Which raises the most important question of this entire video. How much cash do you actually need to feel financially safe? And the answer is not a universal number. But before we calculate that, we need to confront the uncomfortable truth about modern financial fragility. The 3 to 6 month emergency fund rule was never a lie. It was a solution for a different era. That era had stable, full-time employment, predictable career paths, employer-provided healthcare, affordable housing relative to income, slower economic shocks. Today, those assumptions no longer hold. Let's examine what changed, cause and effect. 1. Income became less reliable. In the past, job loss was rare and often temporary. Today, layoffs are strategic, frequent, and large-scale. Entire industries can collapse simultaneously. Job searches can stretch from weeks to months or even a year. Effective emergency funds designed for short interruptions now face prolonged pressure. 2. Living costs became rigid. Many expenses today are non-negotiable. Rent or mortgage, healthcare premiums, utilities, debt payments, transportation. These don't pause when income stops. Effect: cash burns faster than expected, especially during stress. 3. Inflation shrinks buying power. Inflation doesn't just raise prices, it shortens time. A fund that once covered 6 months might now cover 4. But psychologically, people still feel prepared. Effect: false confidence replaces actual safety. Here's the data that forced economists to rethink emergency savings. A majority of households would struggle to cover a few months of expenses without income. Job searches often exceed 6 months during economic downturns. Healthcare emergencies routinely cost thousands. Even with insurance, inflation compounds stress during crises. But the most revealing insight wasn't statistical, it was behavioral. People with larger emergency funds didn't panic. People with smaller ones made rushed, expensive decisions. The money didn't just pay bills, it preserved judgment. Every financial crisis follows the same pattern. 1. Income disruption. 2. Asset instability. 3. Credit tightening. 4. Forced liquidation. 5. Long-term financial damage. Emergency funds interrupt this chain. They stop people from selling investments at the worst moment. They prevent high-interest debt. They allow patience instead of panic. Just like during the Great Depression. Just like 2008. Just like COVID. Different decades. Same pattern. Now we arrive at the answer everyone waits for. The correct question is not, how many months should I save? The real question is, how many months would it realistically take me to recover? Here's the professional framework. Step 1. Calculate your survival expenses. Not lifestyle expenses. Not nice to have, only what keeps your life functioning. Housing, food, healthcare, transportation, minimum debt payments, utilities. This is your financial burn rate. Step 2. Assess income risk. Ask honestly. Is your income stable or volatile? Can you replace it quickly? Is your industry sensitive to downturns? More volatility equals longer recovery time. Step 3. Factor realistic recovery time. Most people underestimate this step. Recovery includes job search time, onboarding delays, first paycheck lag, stabilization period. This alone can add 1 to 2 months. Step 4. Add stress buffer. Emergencies rarely arrive alone. Add at least one extra month for overlap, surprises, and psychological relief. For many people today, true financial safety looks like 6 months minimum for stable careers, 9 to 12 months for volatile income or dependence. This isn't pessimism, it's realism. The goal isn't hoarding cash forever, it's eliminating fragility. Once people reach true emergency stability, something interesting happens. Risk tolerance improves. Investment decisions get smarter. Career choices expand, stress decreases dramatically. Emergency funds don't slow wealth building, they enable it.